Good evening and welcome to a very special interview show of the Prode. Today it's my pleasure to have Professor Viral Acharya sir on our show. Dr. Acharya has served as the Deputy Governor of the Reserve Bank of India and is a renowned economist and an author. Sir is currently the CV Star Professor of Economics at the New York University Stern School of Business. Thank you very much, sir, for agreeing to this interview and welcome to the Prode.
Thank you, Ritwij. It's my pleasure.
Okay. Before beginning, I have a very important news to share with my viewers of the Prod and my listeners of the Ritwij Shandilya podcast. So recently, Dr. Acharya's new book, Quest for Restoring Financial Stability in India, was released. And this is a collection of the essays that Sir wrote while he was the Deputy Governor of the RBI. Special offers on this book are running on Steal a Deal and Amazon, and you can get a discount up to 20 plus 10% on Steal a Deal website. And the best part is that the author's share of this book will all go towards Pratham India for providing free education to the underprivileged children. Check out the link in the description box for more details. So, sir, I would like to start by asking that what was the main idea behind compiling your essays into a book, and why do you believe that India is lacking financial stability?
Yes, Ritwij, I think it's a good question to start with. As I describe in the very starting remarks in the book, the speeches and the essays I gave and wrote during my term, they were in some sense my lifeblood during the term as a deputy governor at the Reserve Bank of India. They were my tool for change. They were my advocacy for whatever reforms we thought that the banking and the financial sector more generally required. Public memory is often short. These speeches come out. Sometimes they have an immediate impact. Sometimes they actually help make the change. Sometimes they have an impact more in the sense of coverage, but the changes don't happen, and some speeches don't even get the coverage. So when I finished the term, I reflected upon the various essays and speeches that I had written. I had started getting some clarity in my own mind as to what were the common themes because of which financial stability seemed very hard to restore in India, in spite of, I would say, a very valiant effort on part of the Reserve Bank of India during my time. And then there emerged this thought that essentially it was due to what I call in the book as fiscal dominance. So I have a very extensive preface chapter in the book, which is not an essay or a speech that I had given earlier. And it is preceded by a masterful foreword by Dr. Y.V. Reddy, who gives a historical perspective on fiscal dominance. And what is fiscal dominance? Put simply, it is the fiscal pressures of the government, the fact that it is spending a lot relative to its revenues and needs to borrow these monies. That creates pressures, and so fiscal dominance is when the government pressures to roll over its borrowing programs starts compromising the central bank's policies. And in the preface chapter, I position fiscal dominance as a theory of everything in India. Of course, I'm exaggerating. But what I'm trying to say is that because the central bank, the Reserve Bank of India, is an all-purpose central bank, it does supervision, regulation, external sector management, monetary policy, liquidity policy, etc. All of these start coming under a pervasive pressure and influence from the government when its borrowing pressures are very large. And so if I could just sum it up in one sentence, essentially the financial stability in India, which is can you keep banks, non-banks, external sector in a stable position? So financial stability in India can no longer be separated from the health of the fiscal situation. So fiscal stability and financial stability have become very intertwined because of the scale of government deficits, because of the pressures that it has created, and because of the weak institutions that we have to safeguard fiscal and financial stability. And in the previous chapter, I provide both fiscal and reforms we could consider undertaking. But at a deeper level, the book is both a summary of my term. It is my diagnosis of the common issue. I don't try to put the attribution of the problems on like 10 different parties, because then you don't know where to start. Yes, everyone plays a part in how a system evolves to a point. But I would say, to me, that is the root cause. And so we have to address it head on. And I think, as I said, my writing is always a tool to be an advocate for change. And I think that's what the book and the preface chapter are.
Okay, so please put some light on the matter that how we can protect the Indian economy from fiscal dominance and its side effects. Like if you can
Yeah,
share some little insights. Yeah.
yes, absolutely. So let me first talk about the side effects. Why is fiscal dominance important? Fiscal dominance is important to pay attention to, because when central banks' policies get compromised across board, they can essentially keep the gatekeeper of financial stability compromised. And I think
Yeah.
that's the real issue. What are the pressures? The pressures on the fiscal come from short-term electoral cycles. They come from wanting to always posture the growth to be at a high number. And the central bank's objectives, in contrast, such as protecting depositors' interests, protecting the external sector, so not allowing the rupee to depreciate in a very rapid way, maintaining price stability, so not allowing inflation to be a runaway phenomenon. All these are very long-term objectives. You can't achieve them with quick fixes. Central bank has to build buffers in the system, and it has to essentially build credibility and commitment on some of these functions, and that only happens over a period of time. So the side effects are that when government is borrowing a lot, of course, the private sector gets crowded out, so their costs. There is this thing called transmission of monetary policy, which is when central bank cuts rates, do they get passed on to the real economy? My borrowing costs come down. Do the borrowing costs come down for a small or micro enterprise? Often in India, this doesn't happen. And one of the reasons is because of the government. Government is borrowing so much that that supply of government paper starts determining bond yields and borrowing rates in the markets, rather than the central bank's interest rate policy. And last, I would say that it can lead to crises, because when fiscal and financial situation are so tight, in the book I call it like being a tight rubber band. It can snap unexpectedly at any point of time. And so these kinds of episodes do happen. We witnessed stress along these lines in 2018, even though it didn't manifest into a full-blown crisis. And maybe just one more point, which is that when fiscal dominance is very high and the government is trying all it can to influence central bank policies, unfortunately, even the private sector, which should be focusing on value creation, innovation, bringing in new ideas, it also starts focusing on primarily rent seeking, lobbying, consultations, and trying to influence the policy so that they are favorable to the present incumbents, rather than actually allowing for creative destruction, entry of new players, and so on. So these are all the side effects. So how do we guard ourselves against it? First and foremost, there has to be, we have to, and I would say if I had to pick three key items here, I would say first, we need an independent fiscal council. This should be bipartisan. It should not report to finance ministry. It should actually report to the houses of the parliament. And its function would be that it would hold a mirror to the Responsibility and Budget Management Act. Put simply, we have the reason why the government borrowing has become so large, the reason why fiscal deficits have become so large, is because we have allowed programs to keep expanding without actually keeping in check what the expenditures are, for proper accounting of these expenditures. And the Fiscal Council can actually fix these things by actually vetting the budget implications of these programs better. Second, I would say we need to calculate in India accurately what is called as a public sector borrowing requirement. So very often the reason why you don't know how much government has borrowed is because it is borrowing off balance sheet, or
Yeah.
government is undertaking certain programs, but they are being funded not on balance sheet, but they are being funded either through government owned non-finance corporations, or they are small savings schemes and so on. Now, what this does is that you never know at a given point of time exactly where we are. Now, that's not a great situation to be in if you need to know where your macroeconomy is, what the risks are, and whether the programs of the government are effective in the first place. So we need to calculate a public sector borrowing requirement of the consolidated balance sheet of the central
Yeah.
government, the state governments, and the um, uh, and the way. And third, I would say that we do need a very serious divestment program. The government still owns majority stakes in several large sectors, which I would not
Yeah.
consider as the government is now very tight and
Yeah.
on financing, and so especially in the midst of COVID, where we have to relief efforts. And how can we program bringing down stakes below 50% in many of these cases, and maybe even entirely getting out? This would also allow it to remit from the operations of these entities. On the financial stability front, I would make 3 points. The government should be allowed to undertake its banking supervision and regulation in an ownership neutral manner. This requires that the Banking Nationalization Act not override the powers of the Reserve Bank of India on public
Yeah.
sector banks. It should be able to replace management, perhaps even require automatic dilution of government stakes if government is not putting in the capital into public sector banks in time. That's point one. Second, I would say the central bank on its own needs to adopt more rule-based decision making.
Okay.
Presently, a lot of discretion gets exercised, a lot of exceptions are made, and
Okay.
many times these exceptions are without sunset clauses. So, they don't always, they become sometimes near permanent features rather than being temporary features.
Yeah.
I think this can be avoided. We have a rule-based framework in inflation targeting. I don't see why we can't have such a rule-based framework with exceptions and explanations being provided in the case of supervision and regulation. And lastly, I would say the central bank does need to hold up its own stance of financial stability as a long-term objective. It needs to repeat this, iterate this, reiterate this as many times as necessary to resist the pressures of fiscal dominance. Besides doing rule-based decision making, it can sometimes say no. It can speak truth to power. It can flag issues such as fiscal deficits and fiscal slippages, which in the end financeability, there is no need to be shy about having an honest discussion about these issues. And in a way, it has to lean against the wind, anticipating these problems and building a lot of buffers for financial stability in good time. In the end, I feel on both fiscal and financial stability fronts, we need to end them even in the midst of COVID as we undertake relief efforts, as we expect bank losses to mount, because it's only if our medium-term prospects look bright on growth and stability front, will the markets be somewhat, light on us on short-term stretch, which is required actually to undertake the needed expenditures.
Okay. Okay. Another very important topic raised in your book is the Monetary Policy Committee, and which you have been a member as well. So, what are your assessments of the RBI's Monetary Policy Committee during your tenure?
Yeah, as I was just saying, just think about the flexible inflation targeting framework that we have in place. It's a very nicely designed institutional arrangement. It appoints an independent body. It has 3 members of the Reserve Bank of India and 3 independent members appointed by the Government of India. The Governor of the Reserve Bank of India has a casting vote in case of a tie. It has been given a very specific mandate to maintain consumer price inflation at 4% with a band of 2% around it, while paying attention to growth. So it has a rule, but there is an exception allowed, basically, that you have to pay attention to growth as well. Uh, there's a very specific policy instrument that's given to this committee, which is the policy repo rate. This is the rate at which the central bank lends money to banks, and through that, it's a dial through which it tries to control the borrowing rates in the rest of the economy. And third, there is democratic accountability. Every single member on the Monetary Policy Committee has to provide minutes 2 weeks after the Monetary Policy Committee meetings are over as to why they voted the way they did. And if the target has not been met by the central bank for 3 quarters in a row, then an explanation has to be provided as to why the breach happened. So as an institutional arrangement, this is a very sound design. I think it has done really good for the Indian economy, both external sector and domestic investors, as well as household inflation expectations for most part of the last 4-5 years have been coming down. In the last few quarters, the inflation has been above 6%, and again, the inflation expectations are rising. But it just shows that actually it is very important to maintain constant commitment and credibility of the inflation mandate and target of the central bank. Overall, I would say that assessment of the Monetary Policy Committee should not take into account just the inflation and growth outcomes. It should also take into account the external sector stability outcomes. The volatility of the rupee has been quite low, since even the direction towards adoption of inflation targeting was flagged in September 2014. This is a very important advantage to the economy. So these gains need to now be secured and further built upon. Commitment of the central bank to inflation stability gets built not over just 4 years. It takes a long stretch of time to do that. So my recommendation is that while the review is underway, that ideally they should give the existing framework a run for another 1 term at least, because it takes a while to amplify and benefit from the long-term gains that one gets from central bank's credibility on the inflation target.
Okay. So the most discussed and debated topic in India is the non-performing assets. So what, according to you, is the reason behind NPA being such a big problem in the public sector banks of India?
See, the real problem, of course, is rooted in the 2009 to 12 stimulus. Again, it was very much the short-term pressures to posture growth in the midst of the global financial crisis and its aftermath. So banks were asked to lever up on some of the infra, steel, power, and other sectors. And, when you lend too much in a short period of time, underwriting qualities go for a toss. Banks start lending down the quality curve. Unfortunately, the problems then got postponed because of regulatory forbearance or not recognizing the problems in time. And this is the key point that I want to come to, which is that one of the main reasons why loan losses are not recognized in India in time is because doing so would lead to a recapitalization bill for the government. The government is reluctant to pay up because it has other immediate expenditures to undertake, and therefore they lean on the central bank to compromise the supervisory standards. And I think this is a fundamental fiscal dominance pressure in a key regulatory function, which is to mark the books of the banks well. My sense is the job of the regulator in part is to mark the books of the banks right, ensure that banks are not overstating the value of their books. But frankly, it is not just a problem that happened with these legacy loans. Over the last 5 years on the MSME asset class, the micro, small and medium enterprise loans, the sector is having difficulty. Nevertheless, if it's for 5 years, it is a structural problem. It's no longer a cyclical issue. But we keep designing a restructuring and relief package for postponing the loan loss recognition on this sector year after year. And this can't go on. And I think this is, to me, the fundamental problem, because the day we mark the books of the banks properly, capital will have to come into banks in a timely manner. If capital is being put up for the lending activity in a timely manner, we will not get the lending excesses and the busts that happen. And even when the busts happen, because capital has to be put up, there will be a demand to recover well on the underlying non-performing loans, to resolve them in a swift manner, to take the promoters who have defaulted on their loans to the insolvency and bankruptcy code and banks would want to earn a recovery. Right now, we are for most part in the kicking the can down the road mode. That doesn't help because the wounds just fester rather than healing. Banks become risk averse. They keep throwing good money after the bad to not recognize the bad loans. So they do what is called as evergreening or extend and pretend of these loans. And it's a terribly inefficient intermediation system. Note that many of our private banks are extremely well capitalized. They are far more aggressive in marking of their books. Not every single one. There are clearly some governance failures there too, but I'm talking about private banks as a sector. And they are lending well. I think they might be able to lend at even lower rates if there was more competition. But right now, a big part of the deposits in the system are with public sector banks who are not actually lending as well. And so overall, the economy is unfortunately paying for this lack of capitalization in the economy.
Okay. A very large issue that is haunting India, according to critics, is the privatization of the public sector banks. Capitalists look this as a jadoo ki chhadi which will solve all the problems of the country, and critics categorizes it as chronic capitalism. So, what are your views on this issue, and how do you see this whole debate?
Uh, See, right now the fiscal situation, Ritwij, is such that we have to put divestments at a minimum on the table. There is no reason why government stakes can't be diluted below majority. The Narsimhan Committee in the 90s, PJ Nayak Committee 5 years back, they've all recommended the government bring down its stakes to 25% or 30%. This would relieve the exchequer from the burden of the recapitalization pressures. Now, I fully agree that we can't just one fine day wake up and say everything has to be reprivatized. Who are the suitors? We have to do due diligence on them. Will they be able to bring financial and technological expertise? Will they be able to bring risk management expertise? Will they ensure that the governance is right? So clearly, the new buyers who come in, and ideally it should be some key institutional investors or large investors who come in domestically or from abroad, but they will have to be a due diligence process. And also they would be reluctant to come in until the balance sheets are in the right shape. So I think we have to think about it as a well calibrated strategy that is actually telegraphed and laid out. And along the way, the governance, management, incentives, and risk controls in public sector banks have to be improved substantially, so that when they are handed over to private owners, they actually have a chance to run well. And to do this, I think it is crucial that the government maintain a very arm's length relationship rather than actually being too close to the operations of these entities. Nevertheless, I think there are a few healthier and well-run public sector banks. I think they could be reprivatized, perhaps even right away, in my opinion. The weaker public sector banks that are not yet ready and where the governance, risk management, technology improvements are required, I would say in those cases, it might be better to prioritize their model to something like microcredit or microfinance. In the end, everyone justifies public sector banks based on performing a development of financial inclusion role. But the problems of public sector banks are actually heavily due to the industrial loans. And that's a paradox in a way that we need to acknowledge. And so we need to prioritize their models into more profitable, socially valuable microcredit, microfinance. If they do underwriting, monitoring, and recovery well in this segment, their valuations will improve. And down the line, they could be reprivatized. So I think it is required. Divestments and reprivatization are required, but it has to be a comprehensive, well calibrated, well telegraphed strategy over a period of time. If it is done in this manner, it would be possible to take the unions along, because otherwise there is no capital coming in and these banks are actually just losing their share of deposits and loans steadily over the last 10 years. The last point, therefore, is that the markets also need to have predictability on how
Yeah.
this is going to work, because only then investors will come in at the right prices. And
Yeah.
the last point I would make is that you don't want to do this under a lot of duress. What you observed during the Southeast Asian crisis in
Yeah.
97, 98 is that these countries had to sell their financial firms, which were government owned, at very
Yeah.
fire sale cheap prices to the FDI investors. In many cases, private equity investors who often came and then just flipped the shares very quickly rather
Yeah.
than becoming long-term institutional investors in these firms. So you don't want to do this under duress. You want to do it as a comprehensive, well-articulated strategy that's telegraphed over a period of time.
Okay. At last, I would conclude by asking that according to the Fitch ratings, the Indian GDP would contract by minus 10.5% in the financial year 2021. And not just Fitch, but other institutions I have also predicted that India's GDP will not do well. So, what, according to you, is the main reason behind this? And do you think that it's only COVID, or there's some external factors to it as well?
Certainly the COVID shock is very, very important. Unfortunately, as I explain in the book, most of my book was written before the COVID shock. In fact, practically all of it.
Yeah. Yeah.
The initial conditions, however, weren't great. And therefore, we
Yeah.
have to deal with our initial conditions, COVID or no COVID. We have to
Yeah.
restore fiscal and financial stability, as I keep saying, restoring them with a commitment to bring them in order for the medium term will actually help us undertake the necessary expenditures in the short run, because the markets, investors, rating agencies will be forgiving of a stretch in the short run if they have a clear
Yeah.
path that you mean business to restore them to reasonable levels in the medium term. But I think the other reason why I think financial and fiscal stability would be very important to secure is because right now we keep paying so much attention to the temporary problems that keep arising, because we have never fixed them for the next decade or two, that we are not able to focus on truly transformational reforms or structural reforms on the ground in land, labor, agriculture, infrastructure, and so on. I think on agriculture, some forward movement is being held, but we need to do so much more on land, labor, and infrastructure in order to improve the ease of doing business. There is no shortcut, unfortunately, to grow, and certainly not when you have had such a large shock like COVID and the associated contraction in the GDP. So I would say fiscal, financial, and structural reforms on an institutional footing, thinking about 10, 20 years ahead, are all required, along with immediate relief and support measures for the most affected states, citizens, and sectors of the economy. And I stress the two are not exclusive. In fact, the longer term reforms are necessary so that you can create the space from markets, investors, and rating agencies to undertake the necessary expenditures in the short run. So I encourage all of you to read the book. The
Yeah.
preface chapter lays out the common thread across the various speeches, and then there are
Yeah.
several sections in the book on individual topics. I
Yeah.
hope you find it a useful read, and needless to say, if you have questions along the way, my email address is on the
Yeah.
internet. Feel free to drop me an email. Thank you so
Okay.
much, Ritwij,
Okay.
for the opportunity to talk.
Thank you. Thank you so much, sir, for taking out the time. And friends, do check out the link in the description if you wish to order Quest for restoring financial stability in India. This is Ritwij Shandilya signing off. Thank you very much, sir.
Thank you.
Thank you.